for free information on stocks, options, futures, indexes. Get to know iknow.com.
Hi, if you're just beginning to learn how to trade, or you're a seasoned veteran, the DVD you're about to watch can help you become a better trader. I guarantee it. Let's go watch the DVD.
In the following session, futures trading superstar Dr. Bill Williams introduces the strategies he uses in stock market trading. He will also try to help you answer the question, should you speculate in markets, futures, or stocks? He introduces his personal stockbroker, Robert Godino, who talks about easy-to-follow strategies which consistently outperform the Dow and most mutual funds.
Thank you. Thank you very much. I appreciate you being here, and we're going to have an exciting few minutes together. And the reason we're here is that Futures Magazine has been making a move toward not only just futures and commodities, but also stocks. And the reason for this is that stocks and commodities are getting a little closer together. And a lot of the strategies that have been used successfully in futures markets are now being used by more and more stockbrokers and more people who are playing the stock market. So our intention and our mission for the next 30 or 40 minutes with you is to share with you some of the things that we've been doing in the stock market using futures type of techniques and also some unique techniques that we have developed and that have been developed by other people, and we have sort of done research on it. And of course, if we take something from you, that's research, but if you take something from us, that's plagiarism, right? So this is pure research. And when Ron and Futures Magazine asked me to do this, I volunteered and said, okay, I'll do it on one condition. And that condition is that I bring somebody who is a dear friend of mine who knows exactly how I trade, and we've traded together, and he is my personal stockbroker. And I can attest to his effectiveness, his veracity, and we'll do this together. And he knows more than I know about what we're going to be talking about tonight. So I'd like to introduce to you Robert Godino, my stockbroker. Robert, it's all yours.
Thank you, Bill.
Congratulations.
I appreciate it. Thank you. Well, thanks a lot. It's really great to see how many people showed up for a stock presentation. I know many of you, or all of you here, are for basically to learn a little bit more about commodities. And one of the things that we had called the class here is, do we really need to speculate? And I know a lot of us, in speaking with many of you, we all have different kind of sections of our money. Maybe a smaller portion or a decent-sized portion may go into commodities. Of course, everybody's got their safe money with CDs, money markets. And then there's, of course, everyone in here. Actually, maybe show of hands. How many people are invested in some sort of stocks right now? Okay. Got a lot of hands up. Great. What we're going to be talking about today is a couple different, not only stock picking strategies, but also something that's really been brought to light is called covered call writing. Basically, it's how people are starting to create an income by purchasing stocks. Now, the other thing I wanted to ask in here is how many people think the market's too high right now? Okay, a couple hands, a couple more hands. What I wanted to do is just go ahead and start off and discuss just briefly why I think we may still experience a bull market, possibly for the next 10 years. And one of the assumptions here, we're going to use some Census Bureau figures. I want to show you this chart here. This is a bar chart of people in our economy at any time that are age 47 to 49 years old. Now we're going to use this to really be our crystal ball to try and forecast possibly where the stock market may go. And what we've noticed here, and I'm going to pull up another chart here in a second, but we're going to use the population, or basically the people who are moving into their peak earning years, 47 to 49 years old, or really in the mid-40s to early 50s, people who are moving into their peak earning years. Where are you going to put your money? Okay? Are you going to, really a lot of people there only have 10 or 15 years left before retirement. Are they going to go into CDs? What's a CD paying now? 4.5%, 5% or so? A lot of people are starting to look at commodities, but of course the majority of the money is starting to go, especially in people's 401ks and personal retirement plans, into stocks. So what I want to do is show you here, if we take a look, you really can't see here at the bottom, but the chart starts in 1920. And you can see that this is basically a bar chart, once again, of everyone aged 47 to 49 years old at any given date. And right here, actually as it starts to move up, I'm going to go ahead and show you where 1995 and 1996 come in. This is going to be our little forecast of the stock market. Now this goes from 1955 up to, well, actually goes up to the year 2035. What we've done, actually a gentleman by the name of Harry S. Dent wrote a book called The Great Boom Ahead. It's an excellent book if anybody's looking to possibly read on the history of the stock market and possibly why he believes also the stock market should have another great 10 years. If you take a look at the spending at the people here, now this chart is 44 to 46-year-olds, but what he also did was he took the S&P 500 and he subtracted out inflation from the S&P 500. So in the 70s, of course, you can see a dramatic correction there. That's not only because of the 73-74 correction, but also has to do with the fact that we had runaway inflation. So I want to make that very clear. But what do you notice about this chart when you take a look at the S&P 500 compared to the people, according to this chart, who are 44 to 46 years old? It continues to go up till about the year 2007. So once again, I think this is pretty compelling that if this is to have any sort of legitimacy, we can really see a bull market continue for the next possibly 10 years. Okay. What I want to do is talk about a strategy that has really come to light here in the last couple years as people have started to get more involved in the stock market. And I want to give you just a little brief explanation of options on stocks. What we're going to be talking about are covered call writing. Basically what we're going to do is we're going to buy a stock and we're going to write a call against it. Okay, it's a nice way to lock in some profit. And by the way, has anyone here heard of covered call writing on stocks? Have a couple hands? Okay, good. Basically, we're going to be dealing with calls for this strategy. And what we're going to do is basically a call that gives you, the holder, the right to buy the stock at a specific price in the future that you decide upon. Now I'm using some generic slides here, but basically we can decide that in the future, if you wanted to purchase a stock at a certain price, you can go ahead and purchase, in this case, a stock, a January 25 call, which would give you the right to buy XYZ stock at a certain price up till January of whatever given year that we're talking about here. Okay. So what we want to talk about here are covered call writing. Now the thing that I want to point out here, unlike the commodity markets, are the fact that when we're talking about covered call writing, we're going to be purchasing, in this case, in the examples we're going to be giving, 100 shares of stock, and then we're going to be writing or selling an option against those stocks. Now, selling an option by itself is, of course, a risky investment because your risk is unlimited. But when you talk about a covered call writing strategy, it's not exactly unlimited because you own the stock that you can deliver back to the person who you've worked out the deal to do a covered call with. So basically, we're going to be talking about selling the option, and we're not going to be talking about speculating or buying the option here. The other thing to point out here is a lot of people say, you know, I'm selling the option, so obviously I'm naked. Once again, remember, we're going to be buying 100 shares of the stock, so you aren't naked. So let's go ahead and just talk about one of the examples here. On an example here, we're going to use 100 shares of a certain stock, and let's say that stock's at $38 a share. So you're going to go out and spend $3,800 for the stock. Then what you're going to do, and like I say, we're going to be talking about just generic examples. If anyone wants to talk about some specific strategies, I'd be more than happy to discuss it after our get-together here tonight. But what you're going to do, and this is something that a lot of people have a hard time grasping, is we're going to sell the option. We're going to go ahead and take the money We're going to go ahead and sell the option and give someone else the right to buy the stock from us. So in this case, we're going to go ahead and buy 100 shares of stock. It's going to cost us $3,800. But we're going to sell a June 40 call at this price, but we're going to get credited to our account $400. So our net out-of-pocket expense is going to be about $3,400. Now let me go ahead and show you why a lot of people are starting to do these strategies. A lot of people think we've gone through a great bull market and that we may start to go into a sideways market. A lot of people think we're really getting to an overvalued position. And if I go ahead and put this chart back up here, and we take a look at 1995 and 1996 here, you can actually see that the 44 to 46-year-olds dips down there. So if this chart is right, we may actually go through a sideways market. That's the type of strategy that we want to use in a sideways market, is a covered call writing strategy. Now, here's how the basic mathematics works on this. You've got an option premium that you received on the stock of about $400. So your exercise profit is $200. Basically, we're taking a look here. If you look at the unchanged rate of return, we had $3,400 that we put up, but we got credited back $400. That's an 11.8% return. Now, in most cases, these returns are realized in anywhere between 60 to 120 days. Okay? So if we look at this on an annualized basis, some of these covered call writing strategies that you may want to follow could literally return anywhere upwards of 50% on an annualized basis. Once again, though, we have no idea. It's just on an annualized return. You can get those type of returns. The other thing to take a look at here is the exercise rate of return. What a lot of people like doing with covered call writing is buy a stock, say at 25, and they'll write a 30 call against it. So not only do you get to take in the premium, and that's going to definitely increase your percent return, but if you also give someone the right to buy the stock, say $5 away from where you purchased it, that's an extra $5 of profit in your stock. So in a rising market, a covered call writing strategy may be good for you also, because in this example here, obviously the person who did this covered call writing strategy bought a stock, wrote an option against it that was a couple dollars out of the money, and not only did they get the 11.8% return with the premium that they received, but they also got some capital appreciation. So in this case, this is assuming over a 60-day period that you wrote an option against a stock, you'd have up to a 17.6% return. It's not too shabby for 60 days, okay? Once again, I know this isn't probably as exciting as trading the S&P on a 1-minute chart, but this is some more conservative money that you want to go ahead and put away and get some consistent growth out of. Let's take into some considerations here. One of the considerations is, what type of stock are you going to buy? Now, a word of warning to anybody who may think about doing covered call writing strategies. A lot of times, some of the greatest covered call writing strategies you're going to find, stocks with great options to write against them, are going to have very high premiums, and high premiums normally come about because there's been a lot of volatility in the stock. And what we've noticed lately is a lot of technology stocks have actually been some of the better covered call writing strategies. Just a word of advice, think about if you really want to be in a small technology stock for 60, 90, 120 days, okay? You may want to kind of not grab for that gold ring and get the real high rate of return when you could possibly buy a stock that you wouldn't mind owning if possibly it goes down, okay? So please keep that in mind. We've had a lot of people in the past who try and follow these strategies, yet they want to go for the best return and they end up speculating. A lot of times it's better to go ahead and take a little bit more conservative stock to do the strategy with. We obviously know what type of rate of return we're going to get. Okay. The other thing that this does is it brings down your break-even point also. On most of these covered call writing strategies, a stock can literally go down $4 or $5 a share before you're actually in the negative. And that's kind of nice, especially for a person who's doing a covered call writing strategy, but is doing it on the type of stock that they don't mind owning for the long term. Okay. The other thing about it is market timing. You know, it's basically where covered call writing strategies do great in flat markets. Let's take a look at just a risk-return ratio here, and then we're going to get into some of our stock picking strategies. Risk-return ratio, of course, commodities are way out there. Stock ownership is on the middle here, but really covered calls have about half the volatility or close to half the volatility of the general stock market. So once again, it's a more conservative strategy. You may want to consider it when you're talking about anything that you want to do and kind of create a cash flow for you on an annual, not only an annualized basis, but this is the type of thing where you're going to create a cash flow really on a quarterly basis for your portfolio. Okay. Let's go ahead and talk about some different stock picking strategies. We're going to take a look at the Dow Jones Industrial Average. And we're going to talk about 3 different strategies that we're going to put up here, and then I'm going to add one also that you may want to follow. These are conservative, well, you're going to be buying high-quality blue-chip stocks for these 3 strategies that we're going to be talking about. Now, this is a longer-term strategy, but the first strategy I'm going to talk about is actually the worst performing of all 3 we're going to talk about here tonight. The worst performing strategy, according to Barron's Magazine, has outperformed over the last 10 years. By the way, it was in Barron's Magazine, but actually Morningstar reported this, that this stock picking strategy has outperformed over 99% of all mutual funds tracked over the last 10 years. So let's go ahead and talk about our worst stock picking strategy. Number 1, on our 2 stock picking strategies we're going to talk about here, we're going to use the Dow Jones Industrial Average as our universe. So what we're going to do here is we're going to talk about a strategy called the Dow 10, or what a lot of people like to call the dogs of the Dow. This is going to be a strategy that's literally going to force you to buy underperforming stocks and sell your winners. Okay, which a lot of people, this goes completely against any of the psychology that a lot of people think today. Everybody wants to buy the stock that's already up 20, 30, 40%. No one wants to buy a loser. Well, our first stock picking strategy is very simple. We're going to build upon this in a moment. But what we want to do is we want to take a look at the Dow Jones Industrial Average, and we want to buy the 10 highest dividend-paying stocks in the Dow Jones Industrial Average. Okay? What we want to do is find the 10 highest dividend-paying, buy all 10 of those stocks in equal increments, hold those stocks for 1 year, reinvest all your dividends, and at the end of the year, reallocate the portfolio back to a 10% weighting. All right? Now, what this has done for us, and by the way, let's take a look at what the portfolio would have, actually, this is 1997 here. This is the portfolio as it stands right now. If you take a look at the stocks, we're talking about Philip Morris, JP Morgan, Texaco, Chevron, Exxon, AT&T, General Motors, International Paper, DuPont, and 3M. So what we're going to do is we're going to buy these 10 stocks and hold them for 365 days. Let's go ahead and take a look at an equity chart, though. And let me try and give you a reason why this strategy may be something you want to implement as far as something in your portfolio. If we take a look at the Dow Jones Industrial Average for the last 25 years, you would have had a total return on a $10,000 investment of $221,000. If you would have followed the Dow 10 strategy, buying all 10 of the stocks, holding them for 1 year, reinvesting all your dividends, and recalculating your portfolio back to a 10% weighting again, we went from a $221,000 return up to a $653,000 return. Now these, once again, are utilizing high-quality blue-chip stocks. And in 1995, one of the biggest questions I get about this is, well, what about the technology sector? How did it do compared to a lot of different mutual funds and stock investments out there? In 1995, this strategy, remember how great tech stocks were in 95, this strategy outperformed every single one of Fidelity's major mutual funds, including the mighty Magellan Fund. In fact, it outperformed it by about 6%. But if you take a look here, we're talking about a $10,000 investment made back in 1971, today being worth $653,000. Once again, it's a great type of strategy to follow, not only in some sort of a retirement account, but of course in just an account that you're looking to go ahead and bolster your returns up. Now, let's go ahead and add a little step to the strategy, and let's move our returns up to almost 20% average annualized return. It's called the Dow 5 strategy. we're going to go back to our same 10 stocks again. We're going to pick those 10 stocks again, except this time what we want to do, go ahead and get my chart back up here. What we want to do this time is we want to buy, well, first of all, let's find the top 10 dividend payers, which we have listed here. Then what we want to do is we want to find the 6 lowest priced stocks out of that Dow 10. So if we take a look here, let's look like the lowest priced stocks here are, we've got International Paper, AT&T, General Motors, Chevron. Okay? What we want to do to follow the Dow 5 strategy is find the 6 lowest priced stocks and kick out the lowest price stock. All right? Whatever the lowest price stock, and in this case, we're going to go ahead and kick out International Paper. So we're going to be left with 5 stocks in the portfolio. Now, let's go ahead and just kind of revert back here to the Dow 10 strategy. We're going to find the top 10 dividend-paying stocks. We're going to pick the 6 lowest price stocks out of the Dow 10. Then we're going to kick out the lowest price stock out of those 6 stocks. And the common thought on this is, really, a lot of people think that the lowest price stock out of these 10 possibly are their fundamentals aren't well, or their revenues aren't as good as the rest of the stocks. Okay? So what we're going to do is buy the 5 remaining stocks in a 20% equal increment. We're going to hold those stocks for 1 year. We're going to reinvest all the dividends. And we're going to reallocate our portfolio every year following the strategy. Now this is kind of, once again, keep in mind that we're not talking about some sort of a extremely aggressive strategy here. Let's just take a look again, though. If you had invested into the Dow Jones Industrial Average since 1973, your total return would have been $170,000. By following this simple strategy of finding the 10, picking the 6 lowest price stocks out of those 10, and then throwing out the lowest price, a $10,000 investment since 1973 grew to $989,000. Okay? That's almost a 20% return. That is literally outperforming over 99% of all mutual funds. Like I say, these are all the numbers I'm talking about are based upon Morningstar. One of the things that had been brought up to me in the last week or so is another strategy that if you just pick the bottom 5 lowest price stocks out of the Dow 10, and you just throw out the lowest price stock, and you leave the 4, which are the 4 lowest priced after the one you've just thrown out, by following that strategy since 1973, according to one of the books that just came out lately called The Motley Fool, it actually averaged 21.8%. Okay? So there's a lot of different variations we can work on here, but do keep in mind, if you do have serious money, the less stocks you have in your portfolio, the more volatility you're going to have on any given time period. So if this is going to be for serious money, a lot of people like to reach for the kind of elusive stocks out there or the elusive returns. A lot of times it may be better to go ahead and take a step back and utilize some of the more conservative strategies like the Dow 10, make a little money, create some wealth for yourself, then branch out into like the Dow 5 strategy and utilizing the Dow 4 strategy. Now, I want to talk about another strategy here that a lot of people, at least with my clients, I have a lot of clients who follow these strategies with real money, serious money, and we're not talking about a lot of speculation here. But what ended up happening was we get a lot of people whose portfolios had 10, 12, 13 stocks in them. Well, what we wanted to do was go ahead and branch out and take a look at, can we follow this type of a strategy utilizing dividend yield on the S&P 500? So we went ahead and we put together a couple screens here, and you're really going to need a database to go ahead and utilize this strategy. But I'll go ahead and put the rules up for you. If you take a look at the S&P 500, and you throw, all we want to consider here are the industrial stocks in the S&P 500. So there are 381 stocks in the S&P 500 that are considered industrials. We're only going to look for A-plus or A-rated stocks out of those 381. We're going to rank the remaining stocks that are A-plus or A-rated, and we're going to rank them by market capitalization. Then we're going to remove the lowest 25% as far as market capitalization is concerned. Then we're going to buy the 15 highest dividend-paying stocks out of that portfolio. And we're going to hold these once again for 1 year, and we're going to do this screen again and recalculate every year. Now let me give you an example of the 15 stocks you would have owned if you would have done this on January 1st. UST International, Alltel, Heinz Corporation, General Mills, Winn-Dixie, Genuine Parts, SBC Communications, Royal Dutch Petroleum, International Flavors, American Home Products, May Department Stores, Bristol-Myers Squibb, Pitney Bowes, Kellogg, and Anheuser-Busch. So this is another way that we can go ahead and boost up some returns, and more importantly, as far as I'm concerned, go ahead and asset allocate over more stocks so you don't have to worry about having a portfolio of only 5 or 6 stocks at any given point. Let me go ahead and back up here, though, and put the performance figures on to show you how much these outperform the market. If you take a look at the Dow Jones Industrial Average and the S&P 500, those pretty much are the benchmarks. I mean, that's kind of the bogey that everybody wants to beat. Well, if we take a look here at the Dow Jones Industrial Average over the last 25 years, it didn't do that bad. 12.76%. S&P 500 averaged 12.35%. If you take a look at the Dow 10 strategy that we just talked about picking the top 10 dividend-paying stocks out of the Dow, we averaged 18.08%. Step down and do our Dow 5 picking strategy, we're taking a look at an average annualized return of 19.98% over the last 25 years. Keep in mind, when we're talking about 25 years, we're going through the 70s. Okay, everybody remember all the stagflation and horrible inflation we had? And then following the S&P 500 stock picking strategy, we're taking a look at an average annualized return for the last 20 years of a little over 19%. Truly beating out our respective indexes handily. And if you take a look at it over the long term, it's really a great way to go ahead and create some wealth for yourself. Now, I want to go ahead and put up one of the CQG charts here, because I want to give you a little background just for a moment on why these strategies are outperforming the stock market and over the overall stock market, and why these things consistently make money. It's really because we're buying underperforming stocks. If we can go ahead, and I'll turn my thing off over here. Let's see. Oh, okay. Let's take a look at AT&T. If we take a look at AT&T, AT&T this year has had a wonderful chart. Can we go ahead and put up like a weekly chart? This is the type of stock that gets put into the Dow 10 strategy. In fact, AT&T has made it one of its rare occurrences as far as being in this portfolio over the last year. In fact, last June it actually came into the portfolio. But for January, because everyone likes to do this at the beginning of the year, take a look at the type of stock that you're buying. The strategy by buying the Dow 10, by buying the highest dividend-paying stocks, are going to force you to purchase stocks that are, for whatever reason, drastically reduced in price. Because, of course, as the price falls, if a company doesn't lower their dividend rate's going to rise. Okay, so this is the type of stock that we're going to have to buy when we go into the Dow 10 strategy. Let me show you what the best performer was last year. Can we go ahead and pull up GE? Symbol is GE. General Electric made a rare appearance in the Dow 10 in 1995. That's what it did as far as 1996 was concerned. We actually own the stock somewhere around $72 a share, and people who are following this strategy are forced to sell the stock, okay? Because it's no longer one of the top 10 dividend-paying stocks. And why is that? The stock's gone up so much that it's reduced the dividend yield. So a lot of times, this strategy is going to have you in stocks that you really don't want to own, and it's going to have you selling stocks that you really don't want to sell. I'll give you another perfect example. In 1995, Sears was added into the portfolio, and a lot of people were not too happy with the prospect of having to follow Sears, because we had a lot of competing stocks. Walmart, Target was coming in. They had a lot of problems. Well, what happened though? Sears sold off Allstate. Sears got back down to their core business. Basically, if you owned Sears through 1995, you were up over 75%. And when you add in the spinoff of Allstate, you actually had a little bit more than 100% return. And subsequently, it did get kicked out the next year. So I wanted to go ahead and just show you some of the different ways that we can make money in the stock market conservatively, but it's going to force you to do things that you really don't want to do. And fortunately, if we could do these things, we should go ahead and outperform the stock market fairly handily. This last year, the Dow 10 outperformed the Dow Jones Industrial Average by about 0.5%. But on all the figures that everyone takes a look at, it doesn't include the spin-offs of the AT&T spin-offs of NCR and Lucent Technology, and also iMation by 3M. So a lot of the numbers we're taking a look at here don't include any sort of spin-offs that these high-quality companies are offering. Do you have any questions so far? Okay. With that, Bill, did you want to go ahead and just talk about a couple of the advanced strategies you guys are using here?
Okay, one of the nice things that we have found is that,
Here you go.
oh good, thank you, is that we are doing some leaps. And a leap is basically simply a long-term option. It could be out a year, 2 years, whatever. You can have calls and put. You can have up to 2 years expiration. You can control 100 shares of stock for a fraction of the price, and it's used in longer-term strategies. So using the same kind of examples and the same kind of reasoning that Bob uses for the more conservative ones, let's take several stocks here. On this screen, as you can see, at the bottom we have the leap cost, the stock price over here on the left, and then the leap cost for 100 shares. So the stock price would be $80.50. So if you had 100 shares of that, that would be $8,000, but the leap cost would be $2,296. On December the 31st, the end of the year of 96, the stock price had gone up to $96.63, and the leap price was $3,750. So if you took all of these stocks here in this group right here and bought 100 shares of all of them, it would cost you about $100,000, roughly, very close to $100,000. If you bought all of these leaps, it would cost you about 20% that much, or just over $20,000. What you made on the leaps, though, was 77%. So your percentage of gross, or your percentage of net from this, goes way up. So what we're talking about is taking the future strategy, taking call options, covered calls, covered puts, and writing the covered calls and taking money from that. Then if you want to go for less output, less initial output, and boost your percentage up, then you could go to something like leaps, which are basically options similar to futures options. And that way you get more bucks for your money. And if you choose right, and we use the same strategies in trading the stocks that we use in the futures market. And Robert mentioned the Motley Fool book, which is a very good book. They also have a very, very good website. So if you want to look for them, just go to www.motleyfool.com, and they will give you the top 10, the strategies, give you a lot of ideas about that. We're finding that some of the strategies, in fact, they came out with a new list the day before yesterday, before we left to come down here. And you can take those lists, and then you can put a chart up on the wall, and you can see where that chart is via Elliott wave, or via the acceleration or the momentum or the balance line or whatever we use in the futures market. And then you can take your judgment down to a very precise place where you are increasing your chances of winning, decreasing your chances of losing. You have a good stock, something you wouldn't mind holding, something you wouldn't mind maybe giving to your kids, and still make a much greater percentage return and approach the futures percentage return by using those techniques. Okay, we are close to ending our time span here. We have about 5 minutes for questions if you have any. Any questions? Yes, back on the back. Okay, the question is, the leaps and the calls are in the money or out of the money relative to the stock price. And
a lot of times what people like to do are buying them about $20 in the money. Okay? In fact, I know when Bill did this overhead here, we actually have the strike prices next to it.
Yes.
So yeah, about
over here
normally
on the right
about $20 in the money.
Okay, any other questions?
Bill,
yes.
When you started the program, you were telling us
Question. Today in the session, the statement was made that basically, I'm not sure these were the right words, but I'll quote you, that only fools buy options, we'd rather write options. The difference is that we were talking about naked options in there. What we're talking about now is the underlying stocks and the naked options both. For example, one of the Dow 10 strategy, which was started a number of years ago, now has billions and billions and billions of dollars in it. And when it first started, I think it was the second week in January, everybody rolled over. Then a number of brokerage firms got very much into this. They sold a lot of, again, we're talking billions of dollars of retirement funds, highway patrol retirement funds, this sort of thing. And whenever one comes out, for example, last year, I believe Sears came out and 3M went in. Mm-hmm. And if you know when that's going to happen, then you're pretty safe. So if you know, say, 3 or 4 days or a week before that happens, you would sell the Sears coming out because you know that in a week there's going to be billions of dollars coming out of Sears, and you'd buy the Minnesota Mining because you know that billions of dollars are going in there. So this is a different kind of setup because you have the underlying stock.
No, but I mean, you're buying the leaps at the end.
Yes. Mm-hmm. But you're buying quality leaps. And you have the underlying quality which has a different personality than futures. Futures is much more an arbitrage market than the stock market is. Okay, we've run out of time. Thank you very much for being here. We appreciate you being here. We'll be around if you have more questions. Thank you.
Pardon me?
Hi, my name is Adam Hewison. By now you've probably heard a lot about our giant footprint technology and just how important it is in the marketplace and how it can help you make money. But I want to show you a good example using children's art of just how powerful our giant footprint technology is. Everybody that comes to our offices, we ask them to take this test, and that's the fish test. Now you're going to ask yourself, what do fish tests have to do with giant footprints? Well, I'm going to show you right now. Let's take a look. I want to ask you at home to take this test with me. What kind of fish do you think this is? If you said a number 3 fish, you'd be right. If you said a ladyfish with lipstick, you'd be right. If you said a yellow perch, you'd be right. There is no wrong answer. It's a fish. And children see things very simply. And as adults, we overthink the market. We overthink a lot of things in life. The market can only do 3 things: go up, go down, and go sideways. And it's been that way since trading first began. It's never changed. And as human beings, we haven't changed either. We still have the same emotions as we had 2,000 years ago. You have to think things very simply. Our giant footprint technology makes it very simple, and it looks at the market just like a child would look at drawing a fish or painting a fish, very simply. But it's very powerful, and the results have been very powerful. It takes away all the noise and verbiage that goes around every market. It allows you to be successful. It allows you to capture big moves both in stocks, futures, mutual funds, precious metals, and foreign exchange. If you haven't looked at our giant footprint technology, you really should take the time. Read the giant footprint story and learn. It's how the markets really work. Bruce, what are the markets you trade, and what markets do you follow with Market Club?
You know, I trade a little bit of everything.
Have you used SmartScan to spot some of the trends in stocks and commodities?
Yes, I like SmartScan a lot. It's it's an excellent tool. It gives you a good trend reading on the stocks or whatever you want to trade. You can tell you give you a good indicator if this, your symbol is going to go up or down, whichever way it's going to go. SmartScan is very helpful. I like the giant footprints a lot too.
Have you used the Trade School feature of Market Club?
I have. I've used Trade School for quite a while now, and I find it very helpful. I've been to trading seminars, investment seminars myself, and the problem there is you have to go all day, and you have to pay a lot of money for it, and you may or may not get good advice. But with the Trade School, it's right there at your fingertips, and you can pick and choose who you want to hear from. And sit down at your convenience and listen to some real experts teach you about trading. It's a great resource.
Bruce, how would you rate your gold membership at Market Club?
It's just a great package when you combine the data feed and the trade school seminars and also all the great smart scan technology. It's just got so much to offer for really a very reasonable price.
Bob, thanks for the business. How do you use Market Club?
I use Market Club in helping me decide what stocks and commodities to buy and sell.
Do you have any favorite features that you use in Market Club?
Well, my favorite feature is Smart Scan. Smart Scan allows me to go in and scan different investments and figure out which one's going to be a good buy. The second favorite feature has to be the price.
What do you think of Trade School, and have you taken any of the workshops?
I do use Trade School. I want to learn why things are moving in the market, what causes, kind of a cause-effect type of thing. So I use Trade School to help me learn more about the market.
Bob, are you comfortable enough to recommend Market Club?
I certainly would. Actually, a couple of my friends that I'm real close with now are going to be going on a trial here to see if this product is going to accomplish what they're looking to do. They certainly have raved about it to them, and I anticipate they'll be members soon as well. I love using Market Club.
Hi, I'm at Membership Services with Market Club. We want you to become a member today, so please give us a call. It's 877-CLUB-INFO, and if you give us a call today, we have some really great offers for you, so please give us a call.
Jeff, what's your favorite thing about Market Club?
I really like the Smart Scan and the Giant Footprint technology.
Besides the Smart Scan technology and Giant Footprints, is there anything else you like about Market Club?
Well, the workshops, they're great. I can download the workbooks, read them at any time, anywhere.
Jeff, as an investor, would you say that Market Club delivers value?
Well, that's easy. At $19.95 a month, it's a bargain.
Lisa, what do you mainly use Market Club for?
Well, I've been following the stock market for about a year and started using the Market Club a couple of months ago, and it has just really helped me and my investing and my trading.
Lisa, how do you normally use Market Club?
I mainly use the charts. I really like the studies that I'm able to do, and the trend lines that I can draw are invaluable to me.
How have you found doing business with Market Club?
The people behind Market Club are first class in personal service. I get all my questions answered quickly. Cannot beat it.
Lisa, how have you found Market Club's basic membership so far?
At $9.95 a month, cannot beat it.
Hi, I'm at Membership Services with Market Club. We want you to become a member today, so please give us a call. It's 877-CLUB-INFO, and if you give us a call today, we have some really great offers for you, so please give us a call.
Thanks for watching this DVD. We're certainly glad you watched, and we're certainly glad and hope you learned something, because that's what's important about Market Club, and that's our mission, is to teach you how to become a better trader. And the remarkable thing about Market Club is it's only $9.95. It starts at $9.95, and you can become a member today. All you have to do is pick up the phone and call this number on the screen, 877-CLUB-INFO, and we'll get you set up in less than an hour. But if you call right now, we do have some important bonuses that you will enjoy. So don't delay, don't hesitate, call today, 877-CLUB-INFO. Thanks for watching this DVD, and we'll see you soon.